restructuring, investment, investment structuring, exit planning, jurisdictional analysis, tax planning, and advisory on various regulatory as well as tax matters. He has, as I mentioned, he has deep experience dealing with FEMA matters, real estate matters, pharma matters, staffing, startups, fintech, and top tier listed companies on various advisory engagements. A lot of these, startups, unicorns, promoters of unicorns are clients of Amit. So he is a commerce graduate. He pursued his law graduation, chartered management accountant UK, and is also a member of ICAI. He is a rank holder in CA final as well as inter. He is a gold medalist and also a rank holder in graduation exams. I must tell that he is a prodigy in by himself. He is also a speaker across various forums on tax, regulatory, and valuation aspects, and he has addressed more than 100 seminars. He's also a visiting faculty at IIM Bangalore and corporate programs. I also would like to now introduce Atul. Atul, he's a senior manager at Eka Advisors. I must also tell you guys that I have had the opportunity to work with both Amit as well as Atul, and every time that I have had a work opportunity, there has been immense, knowledge gaining, and they are very, very generous in, sharing their knowledge. Atul, again, he has worked with various listed companies, multinational companies, Indian promoter-led companies, and startups, as well as real estate sector, pharma sector, e-commerce sector, etc. He has more than 10 years of experience in valuation, transaction, and M&A tax advisory. He has worked on internal as well as external restructuring, cross-border transaction, buy-side, sell-side transactions, repatriation of funds, ESOP planning, tax due diligences, etc. He is an avid traveler, and we now here have the opportunity to hear both the gentlemen who have immense knowledge. Thank you very much for the opportunity for introduction, BVA team, giving me the opportunity to introduce. Thank you very much. I now hand over to Shilpa.
It's the speakers forum now.
Thanks, Kusum, for the kind introduction. Good morning, all of you, on a Saturday morning. Nice to see so many of you up and awake. So the next couple of hours, what we will focus on is, given this is a Valuers Forum, we'll touch upon a little bit of basics, but also at the same time focus on the practical aspects that we have come across in various situations involving a valuation. And again, we can keep it interactive. Anything you would like to share, please unmute and share, or any queries that are there, you can sort of check or request them then and there itself for a clarification. With this brief introduction, we'll just get started with the slides. This particular presentation, I and my ex-colleague Atul will be taking, and we have split the presentation between the two of us in various sections. With this introduction, I'll get started. Atul, if you can move to the next. Also, if you can make it slide shorter.
It is, Amit, you're able to see it?
No, it's only full, the thing is up here, PPT.
No?
No, I will present it. So can you, yeah. Hope my screen is visible.
Yes.
Okay. So these are the contents today. Most of it may be basic or repetitive. Please let us know, and then we can skip and move on. Key considerations in valuation of business or shares. Then what are the methods typically adopted? And we'll briefly touch upon asset-based method, market-linked methods, DCF method. And in DCF method, bulk of the deliberation is going to be around specific aspects, like say you got a convertible instrument, how do you treat it? Say you got an ESOP, what would be the treatment of it? Likewise, with some amount of debt that you raised during the explicit period, what would be the treatment of it? It's more going to be, I wouldn't say case studies particularly, but whatever nuances that we have come across, various valuation engagements we have included as part of specific aspects under the DCF method. And after that, we just put a couple of slides each on a fair value based method based on weighted average, and what should be the parameters that you will consider in the weighted average methodology. And also the next part would be on the M&A, if you're doing a valuation for figuring out a swap ratio, be it a merger or a demerger, what specific aspects you will essentially look at and how does it work. And also we added some legal basis to this whole swap ratio in case of a merger and a demerger. With this thing, we'll just get started. So logically speaking, what are the basic factors which are influencing the valuation of a business or a company for that matter? It will essentially be first and foremost the earnings or the cash flows that the business is throwing up. That will be more often than not the most critical aspect driving the entire valuation. And then of course you've got underlying asset value. This is more if you're looking at the factory sort of a thing acquisition, which comes down to a replacement cost. If you have to replace an existing asset, how much you'll end up paying. And also it is also very relevant in case of real estate companies which are having land banks, not so much so just an operating type of business. And again, the other factor would be what is the value of the company which is similar in an arm's length transaction. So these are very simple cash flows which is inherent to the business, valuation of asset which is based on market price or replacement cost for that matter, which we are going to look at. Then we also got this multiple based or transaction comparable transaction linked valuation, which is this arm's length. So these are the three broad methods also for valuation, but these are again the factors which are going into it. And then other factors that are there, which part of it represents the goodwill of it, and all other aspects would be more like inputs into a valuation. I'll not sort of stress too much upon it. Each of this because as we go along the valuation, we'll look at these things. So critical thing to note here is if I'm doing a DCF valuation, broadly speaking, the value of underlying assets on an individual basis is not relevant except for cash that is on hand upfront. Because everything else, the understanding is that if you've got patent IP, which is much better than others, the logic there would be that that will be reflected in the cash flows that is there that will arise out of the business. And you don't need to necessarily, or you don't rather need to do a valuation of individual assets. That's broadly the thing. But all these factors would be relevant when you're sort of assessing the viability of the cash flows, because essentially in valuation, what happens, as all of you would be aware, it is a backworking exercise. If it has to be done that way, it can be done. And it's essentially GIGO, like whatever factors you feed in, you get the necessary output. But that said, what would be critical is testing the inputs that are going in. Are they reasonable? Are they viable essentially? Such that you'll always be able to sort of undertake the valuation which is technically defendable and also which is reasonable given the nature of the business. With this brief introduction, moving on, what is critical to understand, which I guess all of you would be aware, is the difference between valuation and pricing. Pricing would be more where we are taking a related commodity price or a share which is comparable and essentially benchmarking the price of the company to an independently quoted price, or value of a company to an independently quoted price, Typical thing could be for listed company, you always get a P ratio or a EV by EBITDA multiple. If I simply take that multiple, apply it to the company that I'm sort of looking at, that will become pricing, which is not so much so in terms of not a very tedious exercise. It is more of finding the right set of comparables or the benchmarks and then applying it to the company on hand. On the flip side, if you look at a valuation, it is more inherent or intrinsic to the company, which will be more like a bottom-up valuation where you will end up taking the cash flows, applying a valuation methodology like a DCF method, etc., which is going to be a lot more cumbersome. So what is critical to sort of appreciate is valuation would be more company specific. Pricing, the benchmark would be market determined. It could be in a comparable transaction or a comparable company method. And then you simply pick up that particular multiple and apply it to the company on hand. And also valuation will be multi-period, and pricing typically would be either a forward multiple by a year, or at best it will be the current multiples that you will end up considering. So that's a critical difference between the two. And again, more often than not, what happens is DCF can throw up any sort of valuation, because if your projections are significantly optimistic, then the value would be great. What at least I have seen always is the pricing methodology being applied largely to sort of do a sanity check of the valuation that you got under the DCF method. So it sort of helps us not to go haywire in terms of the valuation that we do. It has to sort of tie in with the industry that we are sort of doing a valuation. Now, that said, a lot of these companies, which are new age or tech companies, getting valued at significant or priced rather at significant premium to the book value or the cash flows that they're generating. And often quoted example is Zomato, which has always incurred losses, has been incurring losses as we speak. How do you essentially undertake a valuation of it? It is very challenging, because many cases which have come to our notice as well, which are startups, the company would have just been a Series A startup, but the projections would be throwing up a 200 or $300 million valuation. There is no real way to sort of figure out what the value would be through a DCF valuation in those cases, especially where the company is going to be or is a very is in a nascent stage or as a startup, as I mentioned. So again, for mature companies, it's much more easier to sort of apply a method and do a valuation, because it is going to be a lot more consistent compared to startup valuation, which is erratic. And again, in case of startup, more often than not, what essentially happens is whatever is commercially determined value, that will drive the transaction, and it's not necessarily going to be a bottom-up approach. And also, what is also happening in many cases is because right from other than sales, pretty much all other parameters would be negative, like starting with EBITDA. Most of the cases it will be negative, and once EBITDA is negative, you'll naturally have PBT, PAT, everything being negative. So there again, it will be a sales related multiple. Again, that will be more a rule of thumb valuation that the investors consider, given what other companies in a similar space are being priced at. So in terms of methods, what we have done is split between what would be the three methods, which is asset-based, market-based, and income-based. And if it is income-based, effectively it will be discounted cash flow, or again, if you're doing a valuation of any sort of IP, it will be relief from royalty method, which is essentially a multi-period projection, which is more of a cost saving rather than an income, which is in the case of DCF, how we do. Again, you got this market-based and asset-based methods, and typically combination of two methods at least would be used. Book value not relevant in most of the cases. It's very rare that you will give any importance to book value these days. more for new age or startup type of companies. If it is going to be hard assets that are there, like say a pharma plant or something, then replacement cost also may be a good benchmark there. Again, there is no right or wrong here. It depends on the objective with which you are looking at. And again, as I mentioned, more often than not, a combination of methods are used, which is comparable transaction or comparable multiple method along with DCF with appropriate weightage given to both the methods. Atul will take this part.
Yeah, thanks. So as Amit mentioned that there are broadly three methods of valuation. One is asset-based, second is the market-based, and the third one is the income approach. So in the case of the asset-based method, so this is I think the most easiest of all the methods, and even income tax also under the Rule 11, you also prescribe a similar methodology for determining the fair value of the equity shares, wherein what we generally see it is you have to just consider the book value of the assets and reduce the book value of the liabilities, and the resultant numbers gives you the equity value of the company. And here one thing to notice, which generally people don't or tend to ignore it, is if we go through the financial statements or the audited reports, auditors report and all, they would specifically carve out or mention about the contingent liabilities which are being mentioned. This contingent liability generally people do not include it while whether it's under the asset based method or under DCF. But as a valuer, we should see the probability, because there is a liability sitting in the books. It's contingent, although need to have a discussion with the management just to determine the probability of a outflow pertaining to that liability, and make up appropriate adjustments pertaining to that while arriving at the fair value. So there, some sort of estimation would be required more just to determine the probability of the outflow pertaining to that contingent liability, and that's how and reduce it from the asset, and that gives you the fair value of the equity shares under this method. And as I mentioned that this method is generally, or as Amit also mentioned, that this method is generally used in the cases where the company as such does not have major operations, but say a company is having a substantial amount of substantial value of land sitting in the books and is yet to carry out any operations, and you want to value that company. Then in that case it would be advisable to determine the guidance value or the fair market value of the land, wherein you may need certain inputs from the uh, 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 engineers who are also carrying out the value of the such properties and all, to determine the value of that land and then make appropriate adjustment. So from book value, you have to move to the fair value of those assets, and appropriate adjustments are required to be given. So this is one example. Then the other cases are lot of time we have seen that they are holding companies which are holding assets or having investments in multiple entities, or they are have made investments into the stock market and all. So there also the asset based method is used to determine the value of that holding company, and there again we have to replace the book value of the assets with the fair value of the asset to arrive at the realizable value under the asset based method. Then apart from that, the other thing from a startup perspective is to be considered is if say suppose the company is having certain form of IP basically sitting in the books, so that also needs to be seen it. And the company is not carrying out any operation, but only the IP is sitting in the books. Then there we may have to use a combination of the method where at least for the IP determination we can do a say relief or royalty method or something, some other form of method applicable to such intellectual property, and make again the appropriate adjustment to arrive at a asset based method. So although the asset based method is a single method, but depending upon the situation you have to combine or use the other methods also to determine the value of the company in those situations. Yeah, you can move to the next slide. Yeah. So this is what we discussed now. Like in the asset method also, there are multiple things which you can do. It is where the company does not have anything as such, like there's no land sitting where you can determine a fair value, or there's no investments being made, or there's no IP as such sitting in. Then in that case, you have to just take the value of the assets, book value of the assets, and just reduce the book value of the liabilities. Only one thing to note is, if say suppose there is some past receivables, and or there is some sort of a there is some past receivables in any form is sitting in the books, that you need to assess that whether that is realizable or not, and make appropriate adjustments. Like say suppose you have a some receivable which is sitting in the books for more than 1 year or 2 years, then at least you should take, as a valuer we should take out a analysis whether that actually the amount is realizable or not. If you perceive that the amount is not realizable, or there is going to be certain amount to be spent in realizing that amount, then accordingly the appropriate adjustments needs to be made, so that the fair value under this method can be determined. Then the next method is the net replacement value method. Is basically, this is generally we have seen in the case of the purchase price allocation, where the company by one company has say acquired another company, or has acquired any assets, any business by way of a slum sale. Then in that case, the value of the plant and machineries are determined using the replacement cost method, whereby you determine, or you list down the, from the fixed asset register, you list down the name of all the fixed assets which are sitting in the books, and determine that when was it acquired. Based basis that and the nature of the assets, you make a adjustment to those cost of acquisition of those assets to the with the inflation related to those assets. And once the value is determined, there you can apply a depreciation or some sort of obsolescence on that, and then the value is determined. So there also, generally we have seen it is the large companies generally tend to take the help, or the valuers also, or the auditors also insist that you should take a help of a registered engineers also to carry out a valuation of the plant and machinery in most of the cases, basically. And last of the methods is the net realizable value method, where you have to just determine that if any asset is sitting, say suppose the company is making an investment in a stock market, say for instance, then in that case you have to determine that what is the market value of those shares as on that date, and whatever the cost associated to that assets, if you are going to sell it in the open market, then what you are going to incur it. So it can be in the form of a, say, short term or the long term capital gains, or there can be a stamp duty implication or some other charges which you have to pay while selling those assets. Then that you reduce it, and then you will arrive at a net realizable value.
Now, Atul, just 1 minute.
Yeah.
Say, for example, land and building and plant and machinery, I have already, already existing report is there. Okay. As a SFA valuer, can I minus this selling cost and tax and stamp duty? As SFA valuer, am I permitted to reduce the land and building or plant and machinery value?
Yeah, you should. If you are using the net realizable value method,
Yes.
then you should ideally make the adjustment to pertaining to that. But generally, in the case of the land and building and all, we don't make such adjustment, because the intent is to hold it for long term purpose. But these adjustments, we generally see it in the case of, say, you are holding a mutual fund, or some sort of shares or something, where the intent is to sell it within a short term period. It's just kept it as a liquid, for the purpose of liquidating it, or to, it's like a cash equivalent, basically, sort of.
Okay. But eligibility wise, yes, I can deduct from land and building plant and machinery valuation if they have not already considered this.
Yeah, you can consider it.
Okay. Thanks.
Yeah, we can move to the next is on the market link method. Now, under market link method also, there are two types. Basically, this is applicable for the company which is already in operations, or the company which are listed, basically. So like if we see the SEBI regulations and all, ICDR or LODR regulations or takeover code and all, there for the listed companies, they've already prescribed certain methodology, which is like 2 weeks higher of the 2 weeks volume weighted closing share price or the 26 weeks basically. So that is the method which has been prescribed under the SEBI for the market price, and that's a sacrosanct method. We cannot deviate or use any other form of a method in those cases, and we have to strictly follow those methods. And it's specifically applicable for the listed companies when you are doing a valuation, and there is a specific purpose to carry out such valuation. Now, from an unlisted company's perspective, there can be two things. One is you take out the comparable companies. So suppose a company is in a cement sector, basically. So you determine the value, or you see that the company which are comparable to your company, which are trading in the cement sector. Then you basis that you determine the multiple basically, and this multiple can be a revenue multiple or a EBITDA multiple, book value multiple, or P multiple. So these are the four sort of a multiple which we generally see it. And there also, different valuer has a different methodology to derive it, because the multiple, either you can determine the share price as on that day, or you can take some sort of a volume weighted average. If say suppose there is a lot of fluctuation happening in the market, and say you have to say we take an example of a COVID only. So now in the month of the March 2020, the value of the all the share prices went down significantly. But there, the call which was taken by most of the people was that that was one of the event which had happened. So you if you take the value or the multiple determined as on say March 31st, 2020, the value of the company would have been significantly lower. But actually the case, that's not the case. Therefore, instead of taking the market price of the listed companies as on that day, many people had gone and taken the either the simple average of the share price during the entire 2020 2019-20, or they've gone into the volume weighted sort of a method also to determine the multiple at that point of time, and accordingly that multiple have been applied to determine the value. Now there also what we do it is, this method is generally what we, apart from the cases which I've told in the case of the SEBI related aspects, this method we generally see it is generally applied either if you are just you don't have any form of information about the company, and you have to just quickly do some math and arrive at the value of the company. Then this method is applied, or this method is used as a sanity check for the DCF method. So you have already done a method valuation in a DCF method, and you just want to see that okay, whatever the inputs has gone, is it comparable, or whatever the companies who are trading, are they trading in the same range sort of a thing. So in that case that is applied. Or the third case is where because of certain reasons you feel that DCF is not giving a value, or there's too much of a deviation between the market multiple method and the DCF method, then you use the combination of the two methods to derive at a value. So that is one on the market comparable method. The next method is which we again call it as a comparable method, is basis on the transaction multiples. So now what happens is in the market we keep on hearing a lot of deals which are happening basically, and those deals are happening at since those deals are happening at between the third parties, it's considered that these are at a fair value, and that can also be used as a benchmark to derive at the value of a company. Basically, now say if we take an example of a cement company. Now cement company is generally seen as is their the value of the companies is determined on the basis of the what is the capacity of the plant which they have installed, like on the basis of the metric uh, how many tons of the plant is there basically. And say suppose one company is trading at a valuation of a market cap has 1,000 crore, and it has a capacity of 100 basically. So then accordingly you have you will be able to arrive at a value per ton, and the same thing you can apply it to your company and arrive at a value. So similar examples are used for the telecom sector or a power sector sort of a thing. Amit, you can move to the next slide, please. Yeah. So in this slide, as we discussed this, now here like 4 or 5 methods of arriving at a market linked valuation. Generally, what we have seen it is for the startups basically. Uh, Revenue multiple is the first which is applied. Reason is the early in the early stage the company is not making a profit. That's why the profit of the company, even the EBITDA of the companies are negative. Therefore, EV and EV by EBITDA method is used in those cases. Sorry, EV by revenue multiple or the equity by revenue multiple is used in those cases. But if the company has a heavy debt and all, then in those cases we generally apply a enterprise value by EBITDA method, and basis that you will determine the enterprise value of the company, and then you will make the adjustments pertaining to the net debt, basically, which is you will add the cash and reduce. So it's basically similar to what we do. It is after under the free cash flow to the firm method, we determine the value of the enterprise, and whatever the adjustments we are making under the DCF method at that point of time, similar adjustments are made under the market link method also when the multiple is used as a EV by EBITDA multiple, basically. And these adjustments are generally like your cash you will add back, or if there is any debt you have raised, those things you will reduce it. Any non-operating assets are sitting in the books, those you will make adjustments. If say suppose the company has a extra land basically which is not being utilized for carrying out any which is not used for any operational purpose as such and is just sitting in the books, then that also you will use it. Nowadays, if you see it, even the newspaper also, you would have realized that the government has also come up with monetizing their non core assets, which is basically the land which is sitting in the books of the company. And in fact, in many of the cases, you will realize that the share price of lot of government companies are trading below the value of the land sitting in their books itself. So therefore, the government has also realized that they can monetize the land value of that, and they are trying to separate or carve out the land from the entities and take a benefit of that. And in fact, yesterday's newspaper, when the Air India is also selling, it same principle the government is applying in that case itself. So that becomes a very relevant factor while determining the value of.
So one question.
Yeah.
See here, typically, suppose we look at sales, we may take 1 year forward, say 1 year behind, or EBITDA, let's say, typically.
Yeah.
But what happens, suppose you want to take, let's say, 2 years forward? Is there any other adjustment which you need? Reason why you're doing 2 years forward is because maybe there's certain parameters which make the company more stable at 2 years forward rather than at 1 year forward.
Yes, sir. So there, sir, you can use that again. It'll depend upon like if you want to make any adjustment pertaining to the size of the company and all. So those sort of adjustments generally comes in where you will. Then again, that is more on a objective driven rather than any formula driven. Where you see that if you are using a multiple where the listed companies has a significantly higher size basically, and your company is very smaller as compared to that, and again your company is also unlisted as compared to the company which whose multiple you're using it. So at that point of time you may make certain adjustment pertaining to that depending upon the size or the liquidity of the shares which is going to be there. So those sort of adjustment you can definitely consider and make it.
Okay, thanks.
And there also sometimes you can use like you have a lack of marketability also. There are certain formulas being prescribed like a Finnerty model is available and all, which is generally acceptable. Those sort of a models which works more on the principle of a black skull or something like that. So those sort of a formula you can use it to determine the value of the discount which has to be given to the multiples or the final price which you have arrived at. So either of that it can work on.
Okay. Thanks.
Atul, I have a query here. You're mentioning average EBITDA multiple. Okay, suppose mine is a listed pharma company. Okay, and I find more relevant in a particular, whatever comparables or peer comparison I'm doing, I find a few more relatable. So can I go for weighted average instead of simple average EBITDA multiple?
Yeah, you can use it actually. That's not a problem basically.
That's not a problem.
So yeah. So it generally we make such a depending upon. See what happens is if you are taking a comparable, whenever you are using a comparable, there can be two things. One is you'll either take the simple average of those, So this applies in the case of the beta also, or any form of a multiple or comparable when you are taking it. Either you can take a simple average of all those numbers basically, or you can take a weighted average. Weighted average is generally we prefer to apply in those cases where there is a lot of variation in the companies which you have chosen. So there can be a scenario where there is a company which is having a market cap of 1,000 crore or 10,000 crore, or another company which is there which is having a market cap of only 10 crore. So in those cases, ideally, the larger company will drive the multiple or the beta which you have determined it. So in those cases, we would prefer or suggest that always the multiple should be on the basis of the weights. And this weights need not be a market cap itself. It can be a revenue based weight also. It can be a market cap based also. So it would be, up to the valuer to see that which is the best manner to determine it. But it's always advisable because it takes care of the size of the company also in the while computing the multiple or the beta, etc.
Okay.
So if you're good, we can move to the please, if you can move to. So here there are a couple of key aspects which we have to see. It is more like depending upon that when you're applying the multiple, so there can be few things which needs to be taken care of, is or there's inherent issues which is there in this multiple method is it takes care of the company which are trading in the similar space, but it does not capture or take into the account in the company's inherent strength and all basically. So there can be a scenario where the management of the company which you are trying to value is way better than the company, the any listed comparable companies and all. So in those cases, such sort of a things are as such. If you just derive the on the basis of the pricing, if you try to determine the value, then it does not give a correct picture. Basically, those things are not getting captured in the valuation under the market price method. But again, it will be up to the valuer if they want to make certain adjustments pertaining to that, then that can be but determined it. Only thing is those factors then becomes a little objective and can be questionable. So whenever we are making any form of adjustments and all, we have to be very cautious, because sometimes what happens is we don't have any form of a formula to determine any value of such adjustments. It's more of a valuer's objective judgment and all, and which can be questionable, and then the valuer has to justify it later point of time. uh, yeah, Mita, I think that's it. Yeah, so these are the few examples which we have given it, like in the case of the telecom sector, if you see, like in the past, lot of transaction were happened, and in those cases, either on the basis of the tenancy which is there in each of the towers. So if you see any telecom tower, there will be lot of other telecom players which would have hired it, like say Vodafone or Airtel would have hired it from the Indus towers and all. So in those cases, basis that you can determine the value of the or the multiple basically. So it's pretty simple. Like say if you have a market cap of 1,000 and you have 100 tenants, so just 1,000 divided by 100 will give you that for every tenant how much is the value, and that same principle you can apply into your company. Similar thing applies in the case of the cement industry also, where I've just explained that it can be on the basis of the capacity of the power plant, and that you can determine per ton what is the value, whether it's equity value or the enterprise value, and same multiple you can apply it in your company to determine the value.
Hi Atul. Good morning. Actually, how can we make an adjustment into DCF by valuing on option? So you just a couple of slides back you just discussed about applying Black-Scholes model. So
Yeah.
can you throw some light on it?
No, not in the case of the DCF I was talking about. I was talking about more on the case of a lack of marketability, basically. So say suppose your shares, you're valuing the shares which you're valuing it is a unlisted company, and the liquidity of those shares will be less, basically. So in that case, you can use the methods which is available, like a Finnerty model or something. Similar models are available, where you will be able to determine the what can be the percentage, or what is the percentage of the lack of marketability of those shares are there, and that percentage you can apply it on the equity value which you have determined, and that will give you a value of the company post illiquidity of those shares.
Okay, so is there
And
any
that,
literature? Is there any literature available online somewhere? Because I generally
yeah,
take
yeah.
benchmark of the US companies or US literature where we just apply some range, but there is no
No, no,
precise.
they are literature on these models. You will find literature. What we can do it is we can send it out, share with Kusum, and maybe she can circulate it. Uh, we can
Sure,
find out the
Kusum
literature.
may not be available. I
Okay.
will connect to you.
Sure, sure, Shilpa. Yeah, yeah. So.
Thanks, thanks, Atul.
Okay, coming to the third method, which is the widely used, and earlier, in fact, RBI had also prescribed that DCF should be used, but for valuing the for any form of inward or outward in any form of inward remittance and all, or transaction happening between non-resident and resident. And under the Rule 11, you also it's up to the SSC to do the DCF method. Although they've specifically written that it has to be carried out by a merchant banker, but this is used. And I think in 99.99% of the cases which I have seen, it is DCF is used as a method to determine the valuation. Now when we are valuing the DCF, as everyone is aware that we don't have to just do a Excel exercise here. We have to apply a lot of judgment, basically, not only on the projection which the management is given. Although all of us takes a rep on all the projections and everything which the management has given, but from a valuer's perspective, they should ideally go and see that the projections which has been considered, are they justifiable, or is there any form of a metrics available, maybe based on the past performance of the company, or how the similar companies in the similar industries are performing and all, and how their revenue grows or the cost structures and everything are there. So those sort of parameters ideally should be used for the DCF, or while doing a sanity check on the projection, and that is the one of the critical exercise, I would say so, because it should not happen that it's just some input you're giving and you're getting a output of that. So this is the most critical exercise which someone should do to see the sanity check on the predictions of the company. Uh, now, DCF, I think maybe Amit, you can skip this slide. It's okay. Yeah. Now, in the DCF, as everyone is aware, there are two or three things which is very important, or rather, we divide the DCF entirely into two buckets. One is the valuing the company on the basis of the explicit period, and then there is a terminal period. So, explicit period is generally seen as a minimum of, say, 5 years, 7 years, or 10 years, depending upon the growth cycle of the company. So, if the company is a high growth company, and even after considering 5 years, the company is expecting a phenomenal growth, and it's not comparable to the GDP or the inflation of of the country and all. Then in that case, we try to extend the projection cycle to beyond 5 years as well, and ask the management to share the revised projection. Or there can be a scenario where, say, suppose at the end of the fifth year, the company is expecting to incur a significant capex, or undertaking any significant sort of a technological development or something like that. Then in those cases also, we ask the projection to extend the projected period or the explicit period beyond that, so that the revenue which is going to come from that capex, or the technological advancement they are taking it, also gets captured in the free cash flow which has been determined by the company. And basis that, then you can derive the value of the company on the for the explicit period. And then the second piece is the terminal value. So terminal value is generally considered where the valuers think that the company has already achieved a stagnant growth, like until unless something significantly happens, the growth of the company is going to be stagnant, and which is like, say, it will grow at a similar pace to their peers, uh, or say the GDP of the company, sort of a thing. Then for that purpose, we determine the value of the explicit period. And when we combine both the things, then then you arrive at a DCF value of the company. And again, as written here is factors which has to be considered for the growth period. When we have to consider it is like what is the return being given and what is the revenue growth is happening. Like say suppose if the company is growing at a pace of even at the end of the 5th year, the company's management is projecting and it's justifiable that it's growing at a pace of 20 or 25% or maybe 50% sort of a growth, then that's not a stagnant growth as such. Then you should ask the management to extend the projections basically. Yeah, Mithya, that's it.
Hi,
Now,
Atul. Atul, hi,
yeah,
Sanjay here. When we
yeah.
are talking about growth here, we are saying the revenue growth, the company's net profit growth, what growth are we really expressing? And when we are talking about the industry and we are going and checking about the industry, then where do we get that data? What is the growth rate of, and if we don't have, do we substitute it with GDP? Those are the three questions.
Yeah. So first is about the growth which I am referring is generally what we see it is the growth is the growth in the revenue basically. So if the growth of the revenue is becoming a stagnant after a certain point of time, and the management also does not expect that there will be a significant jump in the growth of the in the revenue of the company after that period, that is considered, or there is some sort of a cost saving measures the company is taking, which is going to result in a significant change in the EBITDA percentage of the company, which is going to happen. So that also as a factor which we consider it. But the second one, which I've told, is the EBITDA. Generally, we don't see it as a coming out as an issue. More on the revenue we perceive it. So that's on the first piece. The second piece is um, on the industry. So there, there are a lot of data. So there we have to rely on the past data of the company or how the industry is at that point of time are going to grow. So, a lot of credit rating agencies, like for the Indian companies, a lot of credit rating agencies issue the research on the listed companies and all. So those things can be considered as a parameter, or there are other websites also available like a Yahoo Finance and all, where the data of the comparable companies are available. So here I'm talking about most on the listed companies and all. If say suppose which is readily available or free, this you don't need to incur any cost. You can get the data about it basically, or you can refer to Bloomberg's or Reuters and all. And if you want to use any customized database and all, then there is a Capital IQ and all those, which is where you will provide or the Bloomberg terminal and all, where you will get a more precise data. And in fact, there you will get the data about the future forecast of the company also. Like if say suppose we want to determine the forward P multiple and all also, so generally Bloomberg as a terminal and all those are used, where they project the future revenue of the companies as well, and that can be used as a benchmark basically. And the third one is on the GDP. So GDP is generally we use it to determine that in the terminal value, basically, what is the growth which we are going to apply it. So at that point of time, what we do it is you have a IMF or IMF generally issues the GDP or forecast the GDP growth of the of all the countries across the world for the next 5 years, I think. And that also can be used as a benchmark to determine the terminal growth which you are going to use it at the time of determining the terminal value. I hope I have answered your question, sir.
Yeah, yeah. So just a last clarification, when we are calculating the terminal value, so do we take this industry growth or do we take the GDP growth typically?
See, so there are three factors actually you can consider it. Industry growth in the sense one is, so it will depend again on the valuer's judgment, I would say so. One is your GDP growth. So it will be giving that whatever the or the basic assumption there is at whatever the growth rate the country is going to, or the GDP of the country is going to grow, same growth the company is also going to grow at, and that you can consider it. The second parameter you can use is the industry basically, or the third parameter can be inflation also. So in lot of cases, or nowadays we see that the government publishes the inflation rate also based on the industry as well basically. So that also can be used as a parameter. So it's up to the valuer's judgment and which one want to use it. Generally we have seen that comparison is done with the GDP growth rate,
Got it. Thank you.
but still other two factors also can be considered, and it's perfectly justifiable as well.
Thank you. Thank you so much.
Yeah. Amit, can you move? Yeah. So this is now, sorry, I think the previous slide, Amit. Thanks. So here, the key steps in the valuation is, as mentioned, is one is two aspects which we have discussed about explicit and terminal period valuation. The other thing is to determine the discounting rate, and in discounting rate you have a lot of factors which go into. So depending upon the leverage sitting in the books of the company which you are valuing it, you have to choose whether you want to go with the FCFE approach, that is free cash flow to the equity approach, or you want to go with the free cash flow to the firm approach. And basis that, you will determine whether you have to use the discounting rate as a cost of capital or weighted average cost of capital. So that is the one factor which you have to use it. And then again, whatever the projections management has given, that you need to see it and consider and do some sort of a sanity check that the management is not too aggressive or too conservative, and it meets the criterias which the valuer has to determine or to do some sort of a sanity check on that. And then yeah, then you can apply the DCF methodology, which we'll discuss a little in detail later on. And once you have arrived at a DCF method, then again, generally we suggest on all the say if, the in the case if you're carrying out a valuation, say for impairment purpose and all, the auditors also expect that you try to compare that value which you have arrived at with the other methods also, just to see that there is no too much of a deviation in that. And if any deviation is there, then what can be the reasons, and what is, you can point it out that these are the reasons which are leading to the deviation, and then have a discussion with the management and close it out.
Hi Atul, I have a question here. When we apply a DCF method, we get a value, say for example 100 rupees, and
Yeah.
and when we apply market multiple or something like any other method, I'm not considering the book value or net book value method. When we apply market multiple method, we are getting 125 or maybe 175 rupees, because market multiple method works on the sentiments of the market, right? It can be
That's
up,
true.
down, can be the situation at that point of time in the market. So how do we factor in all those things when we do a valuation? Because when we do all these things, it automatically we have a instances where we find a huge difference, but we are unable to explain to the management or to ourselves as well why there is a difference.
So there can be a multiple reasons. Basically, one is the either one reason can be is whether the projection which the management is given, is it too conservative as compared to the peers or the industry is going to grow at. Because when the market is valuing and you're giving a value, they are considering the future growth of those companies, and there it will and whatever the growth of those companies is going to be there, basis that the and whether the company which you are valuing is it expected to be grow at the same pace or not. So that is one of the major reasons which can be there. Other is there can be other factors like what are the adjustments you have made as a valuer when you have considered the WACC, basically. In that, how much of a additional risk premium sort of adjustments which you have made it to determine the value. So that is the other factor which can be considered at that
That,
point of time.
that I understand, but many times what happens, market is all about sentiments, demand and supply factors, right? So
Yeah.
so now tech companies are in tech platform companies are in very huge in demand, right?
So there in
And
that case, yeah, then in that case, from a listed company perspective, also you should do some sort of a search on that. Is it the market is actually moving the way it should move, or there is some sort of a play around happening? So in that case, what you can do it is, you can, instead of determining the value of that company, if say suppose there is a significant growth in the share price in 1 year, basically the company, the comparable which you are using has moved from say 10 rupees to 100 rupees within a year, and that too there is no abnormal thing which from the industry perspective has happened, then in that case you try to use some sort of weighted average instead of using a value of those shares as on that particular day. So then
so
you can
we
average it out, and whatever the abnormality is there as on that point of time, that you can ignore it.
we generally take trailing 12 months average price or something like that. But
Yeah,
even
correct.
in those cases, even those 12 months does not represent a right picture, because in those 12 months there are a lot of things has changed and there are a lot of things keep on happening regularly.
Yeah.
It's very difficult to consider those historical numbers and or the present numbers where the numbers are determined based upon just sentiments of demand and supply. So this is the problem that I face personally when we apply market multiple method.
Okay, and if say suppose then in that case, if say suppose the value which is there, which has been given by the market, then I would suggest then you can consider instead of taking it as a sanity check, you can consider that also method while determining the fair value. You can consider certain weights around that and use it as a method to determine the final fair value also. Like instead of just using it as a sanity check in that case.
One other follow-up question on that. We actually, when we did a valuation, we had something very similar to this, where the DCF actually went on to the lower peg. And like you said, we did a sanity check of the DCF again and tried to push it up, seeing have we been very conservative on a growth or any aspect. But there, of course, in our case where we were doing, we had multiple divisions, and one division the market multiple was favorable, one side the DCF was favorable. But the management also asked us, won't it be a case where the value of the division can get pulled down by the DCF, even though we might have swing on that? So in that case, how do we convince ourselves? Because we don't want to give a single number because it is still under negotiation. We want to ideally give a range. So in that case, we have a difficulty. And what is the kind of range we can give? Is it a 20% variation between the higher and the lower? Or is there a threshold where we can use it? If you can throw some light on it, it would be very useful.
Yeah, so range can be given as a method. So it can be like what can be the so range generally when we consider as a range, we give a three range basically or three values we determine is one is the optimistic view basically where the instead of just applying a range on the final value only like plus minus 5% sort of a thing, which we generally do it as a transfer pricing. Instead of that, you can just see that how the projections of the company are going to go basically. So adjustments needs to be made there, then and there only, where you can determine the value as a most optimistic value, what is going to be there. And then if say suppose the things doesn't go like the things doesn't go like the way the management is seeing it and you want to give some sort of adjustment there, then you can reduce the revenue to that extent after having a discussion with the management, and that can be the pessimistic view, and the average of that will be the basically the third value, which is or this can be the range basically. So the range can be given, but again it will be generally the range concept is not accepted as such by the Indian regulators. So under the Companies Act or any other law, the authorities are expecting that you should arrive at a final value as a single number rather than having a range basically.
But
Agreed. Only with regard to price negotiation, we have the range. But the management
Definitely.
in our case was afraid that the DCF, if we give a lower value, that will be the point for negotiation rather than any other multiple.
That's true actually. So DCF is because the buyer is also looking at when they are buying it at or they are going to negotiate it, they are going to see the future cash flow of the company itself rather than or any other method as such at that point of time, and they are going to negotiate on the basis of that itself. Then yeah, definitely it will be a challenge, and I would suggest that is to just see the projections again basically, and also try to determine that what is the market factors which are leading to such a high price of the comparable which you have chosen. So there may be a scenario where the comparable which you have taken it may be not so comparable, and there can be certain other factors leading. Like sometimes what happens is we have chosen one comparable, but that company is instead of just doing just doing one form of a business, they are doing some other form of a business as well. Or another example can be is like what I told earlier is say in the case of the government companies and all. So there the significant value there can be a significant non-operating assets or sitting in the books of the company like freehold land which is not used in the business, and the market is capturing the value of that also in the while determining the value of that company. So those sort of factors needs to be identified and an appropriate adjustment needs to be made because you have to see apple to apple, otherwise it will not work out. basically.
Atul, is can DCF value can be negative?
No, it can't be. It can be negative only in the cases where the projections are is too pessimistic, and in fact, in the last explicit period also, you are getting a negative EBITDA sort of a thing.
So
Then
we are
you
getting
have
a negative EBITDA. So my question was that I am getting a negative EBITDA. So management
yeah.
is also expecting that, okay, we will have a negative EBITDA consistently for a period of at least 10 to 12 years or maybe 15 years.
Okay. Okay.
And so what happens that I am getting a loss every year. So now I have
Mhm.
to fund the losses as well, right? Without that, the company can't run, right?
Right,
So
right.
if I keep on funding my losses, so I'll by that process I will the value of the losses will become zero because I'm funding those losses. So
Right,
so
right.
so so in that case, the value of the firm becomes zero,
Correct.
and or equity level it becomes zero because I have already funded the losses. So
Yeah.
can the value logically can be negative in that case because I have to fund the loss. If I am not funding, the business has to shut down.
See, generally, it's not the case basically, because always there will be some inherent value in the company. Like if you take the practical aspect, if we want to discuss about, still Jet Airways become defunct. It never show. It's not going to show any profit as such and all. But still, it has some value. Similar example is for the Kingfisher also basically. So there is some sort of a value will be inherent always there. But only thing is it becomes difficult for as a valuer to determine that what can be the value of those assets as such as on that day.
Because I am doing a valuation of one cable company. So in particular area, they know that they had to incur the losses for at least for next 10 to 12, 15 years. So the value, the cash flow is coming negative. But when I apply market multiple method or something like other methods, the value is becoming like I'm getting 60 million negative value when I apply DCF. When I apply market multiple, I'm getting a value of 50 million positive numbers. So there is a range difference of 110 million.
So then I think in that case, see, one is again the issue is with the projection itself, because if you're valuing it, there is a company which is having a negative EBITDA for 15 years, then I'm not sure, like there's some issue around with the company itself. I would say so, and if the company, if the management is still funding, is going to fund that company for 15 years in spite of having a significant loss, then I think you should check with the management that what is the reason or what value are they perceiving it, and they are still continuing and funding it in such a manner. So that is the one thing you need to check it, because 15 years a company is negative, and it does not, like if you take an example of a new tech company, they are also making a huge losses and all, but there is some sort of a future growth they are looking at it, or there is some sort of a notion around that which is leading to such a significant value. Something like should be applicable in your case also. I think you should check with the management that what is the intent or what is the end game for them basically.
Yeah, and
Because
also to
yeah.
add further, possibly if it is 15 years you are making loss, one, they may not have anticipated the profitability properly, or it could be a reason that they'll run for another 2-3 years and try and sell out.
Market is too much volatile, so it's very difficult, and especially when I am saying about cable industry, this new tariff order and all these things, we don't know. So what happens that it's very difficult, and especially it's very difficult to penetrate it into the retail market. So what happens that the management also knows, okay, I am going to make losses at least for next 10-15 years, but I'll keep on running this business, so I will have better advantages. At least I am present in front of the customers, so customer have an option of mine. So अब Reliance भी आ गया, टाटा का जो डिश है वो भी आ गया. So like City Cable है, there are a lot of other players, GTPL. So in those cases, management also knows that I'll make loss in this particular business in this particular region, but I have to be in the business.
Yeah, agree.
I had this interesting conversation with one CFO of a matured company, wherein he questioned me about the usage of DCF method. He says, Shilpa, why are you attributing value to a surplus cash? Suppose a practical scenario, let us take, I do have really surplus cash. I'll try to pay away all my suppliers and try to have a better pricing. Okay, I will not keep surplus cash. I will pay. Okay, and then I will also think about expansion and diversion plans. Practically, I will not have any surplus cash, even if I take whatever projections you are asking, that value is coming out of surplus cash, practically it doesn't happen. There will be no surplus cash. I'll try to use it in such a way that my future operations are benefited. So I couldn't really know how to counter him.
So in the valuation and DCF, Shilpa, surplus cash that is at the beginning alone is relevant. As and when through the years, whatever is getting generated, there is no value attributed to it. And if you want to reinvest that surplus cash and expand operations further, that will reduce the surplus cash in each of the year in terms of accumulation. And that will itself result in an outflow to start with in a particular year, whenever you're utilizing it for expansion. And on an expanded basis, you'll get start getting higher amount of profit. So effectively, it sort of averages out what he's saying. We'll end up getting there itself. And again, on the other hand, what he's saying is, if you've got surplus cash, if you're going to pay off your creditors quickly and get a cash discount, that will reflect in the EBITDA improvement that you're going to get. Point I'm trying to make here is surplus cash at the beginning of the period of valuation is alone relevant. Anything that arises thereafter is technically not relevant from a valuation standpoint. Either you distribute or you redeploy. That call they have to take. Whether distribution is better or redeploying is better. Essentially, it will come down to the NPV of reinvestment versus distribution.
Hey, Amit, Sanjay, yeah, one question I had got. We are talking about two methods actually. One is the DCF and one is the market multiple. IVSC, I believe, says that we can only use one method, correct? We can't use two methods and the weighted thereof. ICSI says that, but is it true that IVSC doesn't allow that? They say they just use one method for valuation.
But pretty much all the reports, at least what we have done, what we have seen, including all this listed company reports, what is there on BSE website, NSE website, invariably there'll be more than one method. I'm not sure why you need to restrict the valuation only to one method.
Okay.
I think the point which he is referring to is that IVSC mentions that you look all the methods and then choose the most appropriate method for your valuation. I think that's all that Sanjay is referring to.
Yeah,
whereas
right,
in
Abraham.
ICAI
Right,
standards with right.
Yeah, so there's a conflict. So like I was doing one of the valuations in which we were looking at it, and we said that okay, this method, but then when we are issuing report under IVSC, we are supposed to choose one only, and that's where we're getting stuck. And when we're looking at downloads from the other valuers report, as you rightly said, we could see that everyone is using weighted average of the three methods in NAV, all the three methods, different methods that we use. So I wanted to know whether we are doing things in line or we're not doing things in line is something that I wanted to, I mean, to the other members also, this was a question if they can kind of have their personal experience in this.
Sure, Sanjay. And only other thing to add here is typically the book value method would be eliminated. It comes down to market comparable and DCF. Maybe you can make a statement in the report saying both those methods together or in conjunction will give a better picture of the valuation, and then thereafter proceed with it.
Right. Okay, fine. I mean, we can continue because in the interest of time.
So let me just ask a question, Amit. See, in relation to the sanity check itself, and Sanjay also briefly mentioned it. See, when we see other valuers reports, see, progressively what we are seeing over time is that we are coming across the reports of our peers. Like many in this forum itself, we'll be seeing each other's reports. And we know that each person is pretty good as a valuer and they follow a certain approach and a certain principle. So how much of credibility and credence we should give to it, because how to ensure that our valuation is not way off? I mean, you understand what I'm saying, right? There are other valuations done by other members. And how do we ensure consistency? Or we don't consider it?
No, you're saying for the same company, you and your peer, both of you are valued, is it?
Yeah, progressively over time. I've seen, for instance, in one company, two of our peers in the same forum have valued one after the other over the course of the last 3 years, let's say. So how do we consider these reports by our peers?
very difficult. End of the day, I think if you are comfortable with what you're doing, I think you should proceed with it. Again, that will be one of the factor in the sanity check that will go in. Because say for instance, in the past last year, somebody has done and there is a growth of turnovers at 20% during the explicit period, as an example. But you have been given because an investor is coming, they want to bump up the valuation and they've increased it from 20 to say 40 or 45%. Then I think that should be a cause for concern for you to sort of seek an explanation as to why so much of growth is coming in terms of top line, and also how much of it is on account of volume, how much of it is on account of price. Because essentially, if you have got a manufacturing sort of facility, your volume increase cannot happen infinitely. So that would be one of the factor that would, in my view, go into sanity check, and then you sort of figure out, are you being played to give a higher valuation just to meet some specific objective? Because what is also happening, I'll also give a tax side to this. With any sort of investment that takes place at a super premium, all of you would be aware, Section 56(2)(7)(b) tends to impose tax on the company which has allotted shares. And many cases, I've known my friends, others, professionals getting notices or summons from the income tax department, asking them to come over and explain how did they verify the financial particulars or metrics that the company gave while signing off on a DCF report, because DCF essentially it's a working backwards. Whatever number you want, you'll essentially end up getting that. So there is a personal risk involved as well by doing this. So it's best to consider and be a little cautious while signing off on a valuation. It's not like before where you simply sign off a report and get done with it. It is becoming lot more scrutiny is there actually.
So Amrit, Sanjay again, I mean, we are not supposed to say whether the projections are correct or not, because we were given to understand that if you are not comfortable, you adjust your discounting rates or the parameters. So I mean, how can the income tax officers question us about the validity of a client's projection and whether it was correct or incorrect? And after all, it is projections, correct? It's an estimate in period of time.
Correct, Sanjay. So I'm not saying we are going to be held responsible. It's a nuisance value that is going to be there. And again,
True.
if the business historically, okay, I'll give a counter example here. Business historically, it's a mature business. Say, forget the startup. Mature business historically, it's grown at 10-15% per annum, never above that. You are signed off in a report which had a projection which projects a growth of 40% year on year. That itself will be something whether you are comfortable, because whatever discount rate you adjust, it cannot adjust beyond a point in terms of valuation. So then,
I mean, that is correct. I mean, you can't agree to a 40%. You'll have to question the management. But I mean,
then it becomes like whether you sign it and take the risk associated with it. While we can wash off putting whatever disclaimer, essentially there's going to be a good amount of nuisance value that is involved in signing off such reports. And I'm seeing it more and more these days. Again, for companies, it's moving on the assessment side into faceless, and you will have to keep on giving response after response justifying it. Otherwise, the point is they will say we will report if you're a CA, they'll say that essentially it's a threat saying that we'll report to ICI, etc. This I have heard it being made verbally to the valuers who've been summoned.
Sir, one question on this WAC.
Yeah.
Yeah, Chandra. Chandra, you're gone on mute.
Okay, I think there's some problem. We'll proceed and get back. Can continue with this.
Yeah. The next slide is on the approach we want to adopt it. Again, like whether should, so there are two approaches under the DCF method itself. One is a free cash flow to the firm approach, and the next one is on the basis of the free cash flow to the equity. So these approaches basically will depend upon which one to take is on the basis of the debt equity level in the company. If you see that the company does not have any debt as such in the company, then it's fair to assume and go ahead with a free cash flow to the equity approach. And if there is significant amount of debt sitting in the company, then in that case it's free cash flow to the firm approach, which we determine it. And the significant difference between the two is on account of two things. One is the WACC itself undergoes change under these two methods. So in the case of the FCFF approach, we need to take into account the other, apart from equity as a source of financing, other sources of financing, whether it's a preference shares you have allotted or convertible instrument or a debt and all. So any cost associated with that has to be considered here, and applying the weights on each of those costs and arrive at a WACC at that point of time. And in the case of a free cash flow to the equity, we just generally use the cost of equity as a discounting rate and do the valuation. So this is one significant difference in the from a WACC perspective. Other is more from a free determining the free cash flow itself. So under the FCFE method, you have to reduce everything. Basically, you have to start from the PAT made addition to the depreciation, and also make an adjustment on the working capital, capex, and also repayment to the repayment or any additional loan which you are going to take and all in those cases. And you arrive at a FCFA, and then just after that, if any cash is sitting in the books or you have any form of a non-operating asset, you add it, that will give you the equity value of the company. But in the case of the FCFF, since you are considering the cost of debt also in the WACC, you will not make any adjustment into the free cash flow while determining the free cash flow pertaining to those debt, whether it's in the form of an interest or any debt raised or any debt repaid. And you will arrive at a value which is called as an enterprise value. Instead of equity value, it's called as an enterprise value. And there you will make the adjustments pertaining to cash, non operating assets. And the third adjustment will be pertaining to your debt you have raised it, basically. Debt raised in the sense that debt sitting in the books as on that as on the date of the valuation.
So while calculating enterprise value, WACC, in case of there is a borrowing is there in the period 2, 3, how do we calculate a WACC? Is it each year end, or what is the adjustment is required?
So if the borrowing is not significant, then in that case you can ignore that. If you see that the borrowing is going to be very significant, and your discounting factor or the discounting rate is going to change it, then what you can do it is, in that case you can compute the WACC for each of the explicit period and use it as a discounting rate. So you can determine the WACC as on each of the explicit period itself. That will take care of the debt which you are raising in the case of the year 2 and 3, and accordingly you can
Hello. Actually, in case of funding is coming in tranches where I'm getting a funding today, and I there is a condition in that arrangement that I'll get further 30% of funding of 30% funding after 2 years if I'm meeting certain thresholds or certain criteria at the end of third
Yeah.
year or second year. So how would I
Yeah.
consider those numbers into projection, or how do I make an adjustment into valuation?
Okay. So this funding is coming by way of a equity or a debt, or both?
Yes, equity.
Equity, equity value. So only adjustment it can you have to make it is when you're determining the WACC, basically, and each year, instead of determining the WACC as on the date of the valuation, you are determining the WACC in each year. In that case, only your cost of equity, your WACC will undergo change because of the debt equity change in the debt equity ratio. That's the only adjustment you have to make at that point of time. Apart from that, no other adjustment. Like in the free cash flow to the firm or the equity which we are determining it, in that case, there will not be any adjustment pertaining to the inflow which is happening from the equity shareholders.
Okay, so do I need to make an adjustment of the inflow into valuation at which I'm getting after
No,
at the end
no,
of second year or third year?
no, no. You don't have to add any cash which you are going to receive it from the equity shareholder in the projection. You don't need to.
Okay, I don't need. Okay.
Yeah.
But in a case, because investor or investing company is likely to say that if we are going to fulfill all these conditions, so we need to consider those numbers into projection. So
Yeah,
in
you will
that
consider
scenario,
it. Yeah, you will consider. Yeah. You will consider it into the projections. In fact, you will consider the outflow also, because say suppose you are using a equity, you are raising a equity, and that equity you are going to use it say for working capital deployment or a capex. So that also will consider it. The deployment you will consider it, but the inflow which is happening from the equity shareholder, that you have to ignore it completely.
okay. But in that case, don't you think that there will be a mismatch in that scenario? Because if I am taking an outflow, but I am not taking any inflow.
No, the point here is inflow. Why you'll not consider is essentially you're valuing the current equity shares. This is the current capital in the company. If you take inflow also, then essentially you need to enhance the base. And what Atul was basically trying to say is the outflow anyway you're going to consider as investment, which is going to get represented by future enhanced profitability. And that's the NPV, what I was trying to talk about, which will take care.
So what I was planning that I'll consider the inflow, then I will make the corresponding adjustment in once I get a value of the equity, then I will make a corresponding adjustment of that future cash inflow into present value. Then I will that I'll reduce that amount from the equity value which I have derived. Then I will get the present value of the equity.
Yeah, instead of that, you can simply ignore it, right?
Okay.
And I've put a specific slide on this because this question typically keeps coming repeatedly. Once we get there, we'll discuss, including the treatment about additional debt that you raised beyond the WACC discussion that Atul had.
Okay, sure. Thanks.
Amit, you can move to the next slide. Just quickly, we'll try to close it. So this is just a slide which we have put it out. So here we have just put it in the case of the FCFF. How do you consider it? Basically, you have to start with a PBT. You need to reduce your tax, add non-cash items, whether it's a depreciation, amortization, or any other form of accounting adjustments also. Like there's sometimes happens that you have made under Ind AS and all, you have made certain accounting adjustment which actually does not represent any actual cash outflow. So those sort of adjustments also you need to make it. Then working capital, whether it's an inflow or outflow, all those sort of adjustment, you will get a cash flow to the firm basically, and that you will determine discount it with the WACC basically. And here one thing is which generally comes up in a discussion is whether you should use a mid-year discounting or a year-end discounting. What we have seen it is a lot of big fours use like most of the big four rather use mid-year discounting, and the other firms we have seen it is using a India discounting. There is no sacrosanct as such which is the correct or which is the wrong method. Both are acceptable as a method, so any one of that can be use it. Mid-year is more use it more from the assumption that the cash flow which we are discounting, assuming that like cash does not arrive it or at the end of the year only. It's continuing process. Every day you earn the cash. So instead of discounting all the cash at the end of the year, you have to take an average, which is basically comes as the middle of the year. So that's the mid-year convention. Someone wants to use it, that also is correct basically. Yeah, so this is the other where we have just written about that how to compute the WACC. Basically, you have to determine the cost of equity. Cost of equity is determined more majorly based on the CAPM method. And under the CAPM method, it's very simple, like a risk-free rate of return plus the risk market premium which is there, and multiply by the beta, and plus you make a certain other adjustment as an additional risk basically. We'll discuss it a little detail in the next slide. Then next is on the cost of debt basically. So there, whatever the borrowing rate of the company is there as on that date, that you have to consider it. And since there will be a tax saving pertaining to that you have to reduce it. And the third one is your cost of preference shares that you have to consider it. And whatever the weights are there sitting in the books of the company as on that day pertaining to those assets, that you can consider it. Again, if you are using the discounting convention of each year you want to determine it, then the weights also, or all these matters have all the weights has to be determined as on the year end as well, the debt equity ratio and all those things, and make a appropriate adjustment in the WACC to determine the WACC for each of those years.
do we need to consider the cost of reference even case it is a CCP as compulsorily convertible?
If you are going to pay it as a dividend, if you are having a cumulative sort of a dividend in nature, or you are going to pay some dividend on those preference shares, then you have to definitely consider it. If it's a non-cumulative in nature, then it's basically as good as your equity itself, and you can
But
consider it as a
actually,
part of the equity.
but actually it is 0.001% or something like that. So even though it's a cumulative or non-cumulative, does not make any
So that
difference.
nature, then if someone is accepting or dividend of 0.001%, then it is as good as a equity only, because they are
Okay.
relying on the upside in the form of equity rather than the CCP. Then that you consider as a part of the equity only. Then you don't need to make any adjustment pertaining to that.
Okay.
And also, what happens if it is at 0.01%, etc.? It is more like a startup you're talking about.
Yes.
There'll
Yes.
also be a clause which would say that dividend
Convertible.
on CPPS would be on an as converted basis.
Yeah.
Conversion ratio would be fixed. Simply you take and put it as part of equity and apply the cost of equity into that CCPS as well while determining the WACC.
Okay. And in case of optionally convertible debentures which we are valuing, so how do we make that adjustment, the value of the options into the value of debentures?
So I've got a slide on it. I'll pick it up there.
Okay. Thank you.
So you mentioned that liquidity premium has to be added to WACC. Or alternatively, after calculating this by equity value, can we give that a liquidity discount 20% or 30%, whatever it is? Is that acceptable?
So both options are possible. We have dealt with it specifically. Just bear with us for a few minutes.
Okay, thank you.
Atul.
Yeah. So this is basically the CAPM model which we have given it. Risk-free rate of return, then you determine the market rate of return, reduce the risk-free rate of return. Beta will just discuss a little in detail in the next slide. One thing which you have to consider it is all this. Whenever you are considering the WACC, you have to see that in what currency the projections has been given, and the WACC also has to be determined in that currency. Like the initial parameters, like your risk-free rate of return and all those factors, has to be determined in that currency itself. And if any specific country risk adjustments has to be made, then that you will incorporate it here basically. That's one thing, and the period also is next thing which has to be considered, because when you're valuing the company as a going concern and for perpetuity, then in that case the risk-free rate of return or the market return, when you are computing it, those factors has to be at for a significantly longer period. You should not consider like a 1 year government yield or those sort of a thing. 10-year or the 20-year sort of things is acceptable. Similarly for the market risk premium also, the longer the period, the better, because if you're considering a long period, then all form of a risks are getting captured. The market would have seen all ups and downs and all, and hence the value will be more appropriate, or the WACC rate will be more appropriate at that point of time. Yep. Yeah, beta is the most significant, I think, aspect which has to be considered in the case of the while valuing while determining the WACC. So this is basically your market risk premium, and it captures all the market related risk which is associated with any stock or any shares and all. And the methodology which we generally use for the list determining the beta is we try to find out the comparable companies which are in the same sector, apply do a determine the unlevered beta, applying the formula which is written it here basically, and that will give you the unlevered beta of all those companies. Apply a weight to that. It can be a simple weight or a weighted average beta, you can compute it. Then you do again relever that beta, applying the debt equity ratio applicable to your company, and that will give you the beta of your company, and that can be used as a input to the WACC. Yeah, but next slide. So here we are just given some scenarios where generally we don't see a negative beta, but if you are finding a negative beta for any of the companies, then in that case it's generally signifies that the movement of the market is different, or the share price is moving in a different direction as compared to the market. So whenever the market is moving up, the share price is going down, or the share price is going down, up and the market is moving down. Then in those cases, you will get a negative beta. At least I have not come across any scenario where there is a negative beta. Zero beta is also is not a consideration. It's basically is for the cash and government security, which are risk free. So there is no risk as such associated with that. uh, then the beta can be lower than one. Lower than one is means say market is moving by 10 points and the stock price is only moving by 7 or 8 points. Then the beta will be lower than that. So these are generally we see it for the defensive stocks like pharma stocks and all. And beta can be more than one, where the movement in the stock price is very significant, like we see it in the case of the tech companies and all, where even by market is moving by 100 points and the company's share price will be moving by 150 or 175 sort of a thing. So there the beta will be higher than that. This we have just written it about the how to determine the beta for the foreign companies. So foreign companies, if you are determining any beta, I would suggest that if say suppose you have a readily available database like Bloomberg and all those, then that can be used. If you don't have and you want details or the data for determining WAC and other parameters, then I would suggest that you can consider Damodaran. This is he publishes all the data free of cost. There is no cost associated with that, and it's very highly acceptable in the European markets. And in fact, I've seen a lot of Big Four also using the data prescribed by Damodaran. So that is one thing can be considered by all the professionals. And here we just factor in like how to determine the WAC for two approaches. One is if say suppose the WAC is given in a local currency itself, then in that case you apply the CAPM, just you will apply for the Indian market, and you can arrive at a value. The other one is if say suppose you are valuing a company of say any African region, and the projections or the company operates in USD as a currency, then you have to use the method of then you have to start the WAC computation from using the risk-free rate of US risk-free rate of return, then apply the risk premium associated to US, and then you can use a country risk premium. You have to add the country risk premium to that, and you will get a beta in that case. Again, as I mentioned, these all the details are readily available at Damodaran's website. He publishes it in the month of January for every year, and I think there's some half yearly also. He started publishing certain data, so that can be used as a basis to determine WAC for the overseas companies. Next is so this I think we have already discussed, Amit. Okay, next is the perpetuity value. So perpetuity value again, one thing I think a lot of professionals, what they try to do it is when they are determining the perpetuity value, whatever the free cash flow to the firm or the equity is appearing at the end of the period, that they just multiply with the growth rate and divide it by the WAC minus growth rate. So instead of that, I would suggest to everyone is instead of doing that, you determine the perpetuity value for each of the factor which we have considered for FCFE or FCFF, whether it's you're considering the profit or capex or working capital or a tax rate and all. Just determine all those individually for the terminal period and then apply that instead of applying a value to that last number which is arriving at. And the other factor which has to be considered here is, which is most important, which we have already discussed it, but just wanted to highlight is the growth rate, what you are going to consider in the perpetuity. Three factors again you can consider it: risk-free rate of return, inflation, or the GDP of the company. You should consider it. And what we have seen it is your risk-free, your growth rate should not be higher than the risk-free rate of return. So that is also one benchmark you have to do it. Like it can't be a case where say currently say US market is giving a risk-free rate of return of 1.5% and you're considering a growth rate of 2%. So that should not be the case, because even the US economy is not expected to grow at that level. So generally it's considered that becomes a benchmark, or to do a sanity check, that growth rate should be either at par with that or it should be lower than that.
Actually, when we consider the PBDIT for perpetuity, but would it be inflation adjusted, or because if we take there are two ways of doing it. One is with multiplying with growth rate, and one is determining the actual cash flow for perpetuity. But as you know, perpetuity, the value keep on changing year on year. So in that case, what is a better method? Don't you think that 1 plus G is a better method as compared to the determining a cash flow for perpetuity?
No, I'm not saying that you determine it for the each year. I'm saying that you should not apply it directly to the FCFE which you have applied it for the fifth year. So suppose your projection is
Okay.
for 5 years, fifth year may FCFE you would have determined as the last number which you would have multiplied with the discounted. Lot of professionals, what I've seen it, that number they multiply it by 1 plus G divided by VAT minus G, and they arrive it at a terminal value basically, and then again discounting it. So instead of that, what I'm suggesting is you determine the value, terminal value, you multiply all the factors like a PBT you have considered, or PAT you
Correct,
consider,
correct.
you multiply
It's
with the
correct.
growth rate
Each
and
line
that.
item we need to multiply. Each line
Yes,
item
yes,
we need to multiply.
yes, yes.
That's
Not for the
that's
each year, it's just each line item because
yes,
the
correct,
numbers will
correct,
be coming out differently, and
correct,
that
correct,
gives us.
correct, correct.
Yeah, Amit, I
In that
think.
case, I have one more question on the terminal value adjustment. If there is like a negative working capital, then do you ignore it, or how do you do it? Is it only positive that you take it as a part of to perpetuity, or how does it work?
So if it is negative working capital, it's best to ignore it rather than showing it as a cash flow each year, yeah, at least in the terminal cash flow perspective.
But in a case like McDonald's or specialty restaurant, but the business all is in advance, that is collection side. Don't you think that we need to consider those numbers into negative cash flows in perpetuity? Because I did one company valuation where they are in retail business and the whole business was on cash basis, and the credit cycle is generally 30 or 45 days. So in that case, they have a scenario of negative working capital year on year, even in perpetuity.
So that's a tricky thing actually, Harshal. You're right. Like even most of those restaurants also you will have technically negative working capital. Likewise, the cable business, if it is prepaid, that will be the way it would be. But at least somehow it is not digestible to show a negative working capital in perpetuity forever. Uh, Again, that's a judgment call. Essentially, should we take it as zero or should we leave it as is? At least wherever we have encountered, we have taken it to be zero.
Okay, so in perpetuity we don't take any negative working capital.
Correct. In the year-on-year thing, anyway, it will take care of itself in the working capital adjustment, not in the perpetuity. Atul, I'll continue from here.
Yeah.
So this is the gross capex and perpetuity. What we understood. This is more like not the maintenance expenditure because that would have come into your PBDIT computation itself. This is to just keep on going at to keep the assets live. Whatever expense we need to incur, that will be the amount which will come in the gross capex. As a rule of thumb, it will be somewhere equal to your rate of depreciation, roughly, excluding the value of land. So you just take the gross block, what is being currently deployed into the rate of depreciation. This has to be the gross capex. Essentially, the logic here is if you've got a 10% depreciation, effectively the useful life of the asset is 10 years, which means every year 1/10 of the asset has to be sort of replaced. So that's the logic of gross capex in perpetuity. And again, we also provide for this tax savings on depreciation on gross capex. Essentially, if you are incurring 100 rupees each year, you will also get incremental depreciation on that. So we essentially do a PV of this tax outflow, a model which we can share generally what we have been using more as a reference point. We can circulate it to Shilpa and you can take it along with the slide. And once all of those individual aspects are computed, your terminal value would be essentially your terminal cash flow divided by WACC minus G. And as Atul mentioned, generally the growth rate beyond 5% is hard to justify. Typically, we are seeing it somewhere between 3 to 5%, which is essentially, as per literature, it is essentially the long-term growth rate and plus the long-term inflation rate that is there. And again, few of them argue in the context of India, that G can be 8%, 10%, whatever, because we are growing like this. But if you put too high a G in terms of factor, it becomes a little hard to justify, where it will be more like the tail wagging the dog, that sort of a valuation would end up coming. with WACC comparatively being lower now with lower amount of risk-free rate that is there. So once all of it is done, essentially enterprise value would be your explicit period cash flow plus terminal value. You get the EV. EV minus net debt minus pref shares. If you do, you'll get the value of equity. And again, net debt by the cash that is there on balance sheet has to get adjusted, which we have put out specifically here. What are all the items to be taken? Here, if you look at cash balance in the current company, we need to add. One way to do it is add it separately, or in the net debt adjustment, you can reduce it. So that's the reason why we called it net debt. And likewise, there are surplus assets. Each of it I have put a slide specifically. These are the adjustments to be done. And moving on quickly, next about 20 minutes or so, we'll focus on specific practical aspects that we have come across various valuations. Again, happy to take any other feedback or questions you guys may have. Now, first and foremost, the question that always comes is, if I'm doing a valuation now in say October, can I consider the financials as of March 21? Or if they're following a calendar year for projections, whatever, can I consider December financials? Now, the question here is how old the financials could be for you to do a valuation under DCF. Generally, as a rule of thumb, anything beyond 6 months, not comfortable. Typically, it should be like the latest quarter which went by that should be insisted upon as valuation, like however draft form it could be. Taking anything beyond 6 months somewhere, it won't be sort of justified, I would say. Because if you're doing a valuation and say in the month of May or June, the typical response that will come is preceding March financials are not available. Therefore, you take the 1 year prior to that and then start the valuation. It becomes difficult because your first period of projection would be what has already gone by. So that becomes inappropriate, I would say, optically as well. And again, on projection period, broadly, we have discussed ideally 5 years can be considered. Longer also okay, but anything below 3 years, not good. Minimum 3, I would say. 5 to 8 would be reasonable. And again, generally, the logic here would be during the projection period or towards the end of the projection period, at least the company should turn profitable. And in the earlier example that I think Harshal mentioned, where after 15 years also, if you are essentially going to make a loss, then you need to really take a call whether to run the business or simply to shut it down. Because without visibility of profitability, no point running that business. It will essentially come down to that. So again, mathematically, for you to at least have a positive value, the projection should end up becoming positive. And with that profitable towards the end of the projection period, that will be the entry point or the input into the terminal value, whereas a company will end up getting a positive value. And also, if you're giving a valuation for an investor to come in, and if you show a negative value, why would anybody really invest logically as well? If you're going to lose all the money, losing all the money is okay, at least it's zero. You're saying beyond that, you need to probably put further money into it, then the whole projections could be flawed essentially. And again, as we discussed earlier, for new age loss-making companies, there's really, you cannot build a DCF out of it. Becomes challenging for a Paytm or even Zomato to do a valuation. There it will be more like multiple link. But as investment bankers, what they would have underwritten would be essentially it will become profitable after a period of time, like say 6 years, 8 years, whatever. And then they would be market leader because it will be only 2 players essentially in the market. And whatever you're seeing in US happening could essentially happen in India once things mature, and also in China, if you look at Tencent, Alibaba, all of it. So that would be the broad logic for this new age companies. Just moving on, in FCFF method, as we discussed, debt is not considered. as we discussed, debt is not considered as an outflow or an inflow, any interest that you're paying. Likewise, you would have taken interest cost into WACC computation. And again, we discussed whether it can be average working capital that you consider, average capital structure that you consider, or keep the initial capital structure constant through the entire period. Critical thing to note here is part repayment of debt, rather you will not consider it as a cash outflow. Likewise, any new debt you raise will not again be an inflow. That is the way it has to work. Otherwise, if you consider repayment as an outflow, rather it will become an FCFE approach rather than an FCFF approach. Likewise, any incremental debt you raise, the logic here is, should I take debt raise as an inflow, and then I'll also have an outflow when I deploy the debt into, say, a CapEx. So effectively, if you take debt as inflow and a CapEx as an outflow, effectively in a particular year, mathematically looking at it, you will have a zero impact on the cash flow. Next year onwards, you will end up getting higher amount of profitability. And since you're not even provided for the cost of interest, effectively you are going to bump up your equity value significantly, which is technically incorrect. Applying this particular scenario, what is correct in terms of approaches, any debt that you raise incrementally, please do not consider it as an inflow. And essentially whatever you deploy, that will result in higher value. And as I mentioned earlier, it becomes like an NPV. If I take 100 crore debt and I deploy in the business, if 100 crore is going to generate more value than 100 crore, effectively your equity shareholders will get benefited. If 100 crore is going to result only in, say, 60 crore value, the equity holders value will fall by 40 crore. That's the simple math at play. And the cap structure for WACC has already been discussed. Generally, couple more. Sorry?
Just one question on that earlier slide. In case of a debt which is convertible, do we have the same treatment? So, for example, if we have convertible debentures, we don't take it as an inflow and an outflow both.
I've put a slide on it, Sanjay. If you're okay,
Sure, I'll wait then. Okay.
Yeah. Next is, I think, just the slide after this. I think I'll take it up then. Next point is, what is the treatment of share application money? Do you consider it? Okay, the scenario I'll give. You got the share application money, then you're doing the valuation for the purpose of capitalizing or allotting shares against the share application money. In this particular case, two ways to look at it. One is it becomes like a circular reference in effect. If you are considering if the allotment price of the share application money is linked to the valuation you're doing, then effectively it becomes a circular reference. That could be one scenario. Other scenario could be where the allotment price is prefixed, and then you're doing a valuation more for the purpose of compliance. That could be the second scenario. Irrespective, what I would suggest here would be to consider the share application money as debt, and any money or any cash that you collected now anyway under Companies Act, share application money cannot be utilized till you have allotted the shares and filed the return of income, presuming it's a preferential allotment. Then by taking share application money as a debt or debt-like item, you would have also considered the cash that is there in the balance sheet as a surplus item. So effectively, both items will go to net off each other. You will have 100 rupees of, say, application money and 100 rupees of cash. Effective adjustment would be zero. And I would not suggest you considering the deemed or the potential allotment price make adjustment to by basically enhancing the capital base, and also by considering the cash as an inflow as a free cash. That is not recommended, because effectively you will consider a future allotment to bump up the current price, especially when you're doing the valuation of the shares for the current allotment itself. I would think it would be inappropriate to consider the allotment that is yet to happen. And similarly, the next point that came up was what happens if you're allotting shares during the explicit period? Now, do you need to consider the cash that you're going to receive on allotment of shares as an inflow or not? And if you consider the cash that is going to come as an inflow, then effectively your number of shares has to go up. It's logical. If something is inflow, then the number of shares has to go up. Instead of doing these two, best would be just to consider the same debt-like adjustment what we discussed. Please, you can ignore essentially the allotment that you're going to do and the inflow that is going to come. Simply put, you can show that as an inflow that is coming, but not in the cash flow projections that you're going to make for the purpose of DCF approach. But whatever amount you're taking and deploying it towards earning profit, that will go as an outflow in the in the DCF approach. And effectively, it will be an NPV computation as we discussed earlier. So this will give you a consistent approach rather than making another separate assumption saying in future I'll allot the shares at say 500 rupees, 1,000 rupees per share, and then get into a loop there by considering or by assuming the number of shares to be allotted. And then that number of shares which you will allot in future becomes base for the current valuation that you're going to do. So this gives a consistent thing. We have actually done math for both, figured out. This gives a better outcome. And also it's consistent with the approach that we're taking.
Excuse me, sir.
Yeah.
Hello.
Yes, Sabha.
Hello. Yeah,
Yes,
I
please.
do have a question on the share allotment money. The share allotment money comes in once you issue a shares based on some valuation or something. Then why do you consider this as a debt?
No, what I'm trying to say is money has already come into the balance sheet and then you're doing the valuation.
Okay.
So then essentially you got share application money and you also will have the cash in the bank.
Okay.
Now, if I'm considering cash as an asset, and if I do not reduce the share application money, effectively I'm taking post money capital for the purpose of allotment. That I'm saying you need to avoid. You can ignore both cash and share application money in entirety. Two ways to do it. One is you adjust the cash directly and ignore the share application money. Or if you consider cash as an asset, then you need to consider share application money already received as a debt.
Okay.
Hope it makes sense what I'm saying.
Okay.
Next is, I think Sanjay, you were asking on this. Compulsory convertible instruments, how do you sort of consider it? If it is OCD, it's a little different treatment. I'll come to it in a minute. So the way, at least what we have looked at is, if you got a compulsory convertible instrument which has a fixed conversion, then effectively you can consider it as part of your equity itself. And because it is fixed for fixed conversion, you'll also know the number of shares you're going to allot. So you can just take the enhanced capital base and proceed with it. And if the convertible instrument is CCPS, then the discussion is very easy because effectively it has all parameters or all ingredients of an equity share. On the contrary, if it is CCD, then effectively what you will need to do would be the tax saving on CCD, you will have to consider at least during the explicit period. It's again a fact specific thing. If you're having just a nominal coupon on CCD like that 0.01%, and there is a clause which says that interest shall be equal to a dividend that you pay on equity shares on a participating basis, for instance, then you can simply take CCD and tuck it into equity and go ahead with the WACC computation, everything thereon. But say if CCD is having 8% or 10% interest, for instance, which is not nominal, again, the conversion ratio is fixed, for instance, upfront, then at least the better approach would be during the explicit period to consider CCD as a debt, compute what would be the amount of tax saving on that account. While your cost of debt could be whatever interest you're paying, and then that's a treatment that you'll have to provide. While you'll not reduce the CCD as a debt upfront, it will be part of the enhanced capital base of equity shares. So if I've confused you, if it is convertible instrument which is mandatorily convertible, simple thing, consider it as part of equity and also consider it as part of in the existing number of equity shares on a diluted basis. Then you'll get the right answer. Only exception to this or adjustment that you may need to make is if the instrument is CCD with an interest, you may want to consider the tax saving and the interest outgo that you're going to have in the computation.
In a scenario where the conversion ratio is not fixed, how do we make that adjustments? Because conversion ratio.
Then I think you will have to take it as a debt instrument itself, Harshil. Otherwise, it becomes difficult. Even in India, for instance, if the conversion ratio is not determined, the treatment of that instrument is of debt. Again, here, if you've got an OCD, you will have to value the option separately. The debt, treat the item as a debt separately. And if you want to do something complex, you can always do this option pricing model. Break up the CCD amount into what is a component of option and what is a component of debt. I would think in a smallish company, it is unnecessary. You can simply treat this entire amount of optionally convertible instrument as debt and proceed with the valuation.
Okay. We go technically little further. Is there any technical literature available where we can see how this is how the value of the option needs to be determined in optionally convertible instrument? Because we don't have, because as a practitioner, I don't have. That's why I'm requesting.
No problem. This in accounting itself, there is this accounting standards which provide for it. That old accounting standard 30 deals with this financial instrument. Again, the same thing is there in India is I think 109 or something. Where
113 talks about the fair value and 109 talks about financial instruments.
Correct. So in that particular thing, you can figure out this thing. Essentially, in simple terms, without referring to the standard, if it is an optionally convertible instrument, you just do a call option valuation of the option that you got by applying Black-Scholes model, and the balance amount will become your debt.
So actually, the problem we
want the input for that option will be your fair value.
The strike price and the exercise price. This is what we need to determine. So what should be the exercise price in that case?
No, if exercise price is not fixed, then there is no option value. No, Harshil. If the strike price is fixed only, then you'll have option value. If I say that I've issued a 10 rupee debenture, say, and if I say that you take 8% interest and you convert at future FMV, there is no option value there. Zero. The option value will start coming only once you got a strike price. And say, assuming you got a strike price, what you do not know is you do not have what is the current fair value of the share. To that extent, it becomes a circular reference. Because you will find out the spot price or the current fair value basis the DCF that you are going to do now. Maybe you will just ignore this, do the DCF, input this, and then redo the assessment. That will be the way to crack it.
This is Joyjan here. Just a question where the compulsorily instrument is convertible, say after 4, 5 years or say whatever in a future period, and the company pays dividends. So to that extent, the convertible instrument holder loses dividends. So how do we account for that?
Yeah. Typically what happens, Joyjan, is you will have practically, I'm saying from the instruments, if the interest rate, a coupon rate on convertible instrument can be nominal, then they will link it back to dividend that you pay on equity on a participating basis or an as converted basis. Or other way where we have seen CCDs being done is you put there will be a reasonable amount of coupon, like say 8%, 10%, whatever. That will be the way they would deal with it. It will be rarely a situation where you have 0.01% and you don't get to participate in the dividend that you're paying on equity. Okay. This is all I'm talking in an arm's length scenario.
Okay.
So, and as I mentioned earlier, if it is participating, I can simply take and tuck it into equity and so. Next phase is ESOPs, which is a little bit similar to this convertible instrument. ESOP generally when you will exercise is when the exercise price is lower than the DCF value. And also if you're doing a valuation of a listed company where the strike price or exercise price is lower than the current market price, only then it will get exercised. When doing the valuation, you sort of look at it whether the ESOP is likely to be exercised. Because I've seen scenarios, especially in listed companies, where you're given options at prevailing market price, and then the market price of the company has fallen thereafter, and effectively ESOPs will become worthless technically for somebody to exercise. Assuming a scenario where it is likely to be exercised, where your exercise price is lower than the fair value or the DCF value, that is essentially the benefit the employee is going to get. You simply consider this as part of your capital stack. Essentially, you consider the equity shares on a diluted basis. And again, on ESOP, you are going to get some amount of cash on exercise. Whichever year it's going to be exercised or likely to be exercised, you consider that cash at present value. Or simply put, you can also add it in the DCF computation itself in that particular year as an inflow. And since you're considering the expanded number of shares upfront, it is appropriate to consider the future exercise price as an inflow. Better way to do it is do this as a separate adjustment instead of dumping it in the cash flow computation.
Amit, one question here. What should be the stage at which the ESOPs needs to be considered? Like we had a request wherein only an ESOP draft agreement was made and the client wanted us to consider the ESOP in the valuation. So what should be the minimum criteria that should have been fulfilled to consider it?
So generally, Nikki, what we have done is ESOPs granted is what you will need to consider. Whereas in your particular case, it may be a case, if it was a startup, what typically happens is in the SHA itself, you would have carved out the ESOP pool that you need to give, right?
Correct.
There, the understanding would be that this ESOP would anyway be distributed. So therefore, you need to consider the entire amount of ESOP as if it's going to be allotted or granted completely. And again, in the context of startup, the exercise price is going to be nominal. It will be only 10 rupees face value generally. There, whether you consider the inflow or not, it may not make too much of a difference. But in a startup scenario, it is appropriate to sort of consider ESOP in the enhanced cap table. Otherwise, your equity will be giving a unusually high value to that extent of 10 or 20% ESOP pool.
Correct. So you're saying if they have created the ESOP pool in the SHA and not yet granted, we can still consider it for startups, right?
Correct.
Okay.
So then more likely than not, in 90% of the scenarios, the ESOP pool would get used up.
Okay.
But if it is listed company or mature company and all, I would think it is appropriate to consider what has been granted.
Perfect.
Because there would be no SHA or anything like that. It's more like need based and ESOP would be granted.
If the company is not comfortable sharing the SHA with us, is the board resolution sufficient enough?
That should be good. And also what you can ask is the cap table, at least they'll share, right?
Yeah.
Who's holding shares in that cap table? If there is an ESOP pool that's created, that's good enough.
Okay, fine. Thank you.
Yeah.
According to me, board resolution also they may or may not give. MRL could be sufficient, right?
See, from our perspective, Shilpa, that should be sufficient. It's more like how inquisitive you are or how much you want to safeguard yourself. It will come down to that. But again, if ESOP, if they have rolled out the plan, but not yet issued to the employees if they've got the entire legal basis, resolutions have been passed, then essentially special resolution is a public document, right? In any case. At MGT 14, you would have filed. So I don't think that they will push back in giving. You can put it in MRL, and MRL would be basically a reflection of the cap table. That should be good.
For ESOP, private company, it's an ordinary resolution, just a small piece of information.
Then other things is whether to consider pre-money, post-money for the purpose of valuation. Typically, the question that will always come is, I'm yet to allot shares or raise money. Do I need to consider the projections as if I've raised money and show enhanced amount of operations? Or do I consider pre-money terms for the purpose of projection without considering any sort of allotment. This typically becomes a challenge every time. And also number of shares, what will you consider? Whether you will consider the future allotment to be done or only the current base. On this allotment of shares, we already discussed, it is appropriate to consider the current number of shares rather than the expected number of shares you're going to allot. That being said, the projections that you will consider will be typically considering all the expansion that you're going to do. And in expansion, as we discussed, you will not consider the allotment of shares as an inflow, but you'll only consider the deployment of funds as an outflow. And the profit therefrom in the subsequent years will become your inflow.
In a scenario where this company has approved the bonus issue of share, or is in the process of approval of bonus issue, so should we consider those bonus issue in the number of equity shares?
Actually, I would suggest you write both. No, on a pre-bonus basis, this would be your value per share. Post bonus, you simply adjust the number of shares for the bonus issue, and it's appropriate to determine both. So it's just a price adjustment. It is not like a case of rights issue where you're going to get additional money. Was that okay?
Okay. So when we consider the post bonus, the value per share get reduced, right?
Correct. If it is 1:1, for instance, the value will become half.
Yeah, correct.
Just moving on, for preference shares, which is non-convertible, which is basically redeemable, it is on par with debt, except for that you will not get any tax break on preference shares dividend that you pay. Earlier, there would have been dividend distribution tax. Now, at least that is not there. It's essentially only withholding tax that you need to, it is there on dividend payment. But from our purpose, we just consider dividend, preference dividend rate for computing WACC. And it will be preference share capital will be part of WACC. And again, it's essentially debt treatment that you will have to provide. And the other logical question will be, say you got preference shares for 5 years. And after that, effectively, you're going to redeem it during the explicit period. Then you will consider 2 separate capital structures for doing during explicit period, WACC computation, and thereafter.
Okay, so one question on what is the value, Amit? See, for instance, suppose the company is borrowing typically in the market at say 13% rate of interest, whereas the preference shares have been issued at let's say it is 8%, subject to tax adjustment. Let's say, should you not be considering that 13% as the basis pre-tax and for valuing the preference shares on the date of the valuation?
If somebody has given you money at 8%, why will you consider a higher cost?
No, basically, to come to the, I'm only looking at it from the perspective of how much is it worth on the date of the valuation. Okay. That's the only perspective.
If you're looking at market value weights, Abraham, that will be appropriate. Where you essentially, if it is preference share, you will consider the fair value of preference shares, which is 8% coupon with a 13% discounting essentially, where you will value the preference shares at a discount to the fair value, right?
Right.
That's one way, but at least generally we have always taken book value weights. If it is book value weights, then you don't need to do the fair value of preference shares by adjusting it. Okay. And your lower cost is getting reflected in the valuation upside on account of lower WACC.
Okay.
Okay. Already 10 minutes late. Should we stop or can we continue for another 10 minutes?
I think we can continue. Shilpa, any thoughts? I think we'll continue.
Please continue.
It's okay. Yeah, we can continue.
Okay, next aspect is how do you do the valuation of business assets and surplus assets? The distinction between the two is crucial. The logic here broadly is that if it is a business asset, then the income from that income from that asset is implicitly included in the cash flow. Either it is included as an income or as a reduction in terms of cost that is going to be there. If it is surplus asset, you need to consider the net realizable value of it and add it separately. And I'll just give an example to sort of emphasize on where I'm coming from. So I'm running a factory in prime land in Bangalore, and say it's a distillery or whatever in the heart of the city, assuming it's possible. Now, by having this land, we've come across multiple cases where this pharma or few other companies where they're having city-centric properties. To do the DCF of the business, say it comes to 100 crore. You may have heard many cases, clients saying that my property itself is worth 150 crore. How come your DCF is throwing up a value of 100 crore? Now, in that particular scenario, should I consider 100 crore as a value of your business and then add another 150 crore as property value, which is basically the value of the premises which is occupied by your facility, or no? Any thoughts on this? Or
something similar we had where we were doing some on this aspect where the land value was actually much more. We took an approach where we considered it as a lease rent and we reduced the DCF to that like an outflow, and then added the market value of the land as a surplus asset and gave the valuation, which gave a better driver actually in terms of assessing the value.
So I would agree with it, Shilpa. Otherwise, what happens is, to first and foremost, you should not run your facility in the heart of the city. You should run it outside where it is more reflective. There's no because in effect, what is happening is your implicit rent, had it been considered, would have been much higher. Your DCF would have gone down quite significantly. So that is one way to do, which you mentioned, that you assume the rent payment and consider the fair value of the land separately. Couple of the cases where we have been part of, we essentially make an assumption that we'll shift this entirely to a rented premises. This is the rent that we will pay, and consider the fair value of the land separately. Something similar to what you mentioned. The assumption was a little different there. So that is one aspect I wanted to discuss. Second case, like say I've got an IP which is extremely valuable, and I'm using that IP exclusively for the purpose of my business. I'm not wanting to use that IP outside of my business. Question here is, do I need to value the IP separately or no? The point here to note the distinction between business asset and surplus asset is, if I'm using IP for my own business, then because of the IP, I'm getting extra profit, and that extra profit is going to result in higher amount of value or higher value for the business. So therefore, I do not consider the IP value separately, or any other parts of the business I don't need to value separately. By surplus asset, what I mean is, say I'm running a factory in that same example. I'm occupying 5 acres, but another 10 acres of land is empty or vacant. In this particular case, I would consider the second 10 acres as a surplus asset. You do the fair value of it, and you can essentially find out what is the net realizable value of it after considering the tax that would be applicable when you sell the asset. And that is a value you will essentially end up considering for the purpose of valuation. And also say on this land, if I'm getting some small amount of rent, if I've let it out, and that is not my core function, I need to sort of exclude the rent I get from any surplus asset or any cash flow that I get from surplus asset. And surplus asset is typically valued at a point in time. Same thing will apply for mutual fund investments that you made. I'm assuming that you're not a financial services entity. All of those cases, you will exclude the other income. Just look at what is the value of the asset as at the beginning, and your cash flow should not include cash inflows which come from surplus assets. That's critical to maintain parity.
Yeah, I mean, just one quick.
Yeah, I also had a question. Yeah, go ahead, please.
Yeah, Nitesh, I wanted to add to what Amit was saying is, I think there is one very famous case law also which has happened in 90s somewhere, wherein there was a prime property which was being allocated to the management of a company. It was a, I think, Cadbury case, if I'm not wrong. Or was allocated to the employees of that company, and it was just a nominal rent which the employees were paying, which was considered as an adjustment in the P&L account. But since the property itself was located at a very prime location in the Mumbai, the worth of that property was very, very significant. Hence, it got into a dispute, and I think finally the High Court asked, or there were certain valuation reports which was obtained subsequently from different valuer also, whereby they made an adjustment into the P&L of the company by removing the cost, by removing by making the adjustment pertaining to that property itself, basically, and it was added separately into the valuation. So it resulted in a significant increase in the value
Upside.
portion of that company. So there's a
So,
famous case, why I'm forgetting the name exactly, but yeah.
so actually, my question was, you mentioned that we need to do the valuation of the surplus land, correct? So are we competent to do that as SFA, or we have to take the help of land and building valuer in this case, or how do we go about doing it? Or we just take the implicit value of the lease rental, capitalize it, and then arrive at that value?
See, we can do that, or generally it comes down to if it is property, etc. It's best to sort of put it on a registered, chartered engineer if it is complicated. If it is land, typically what happens is most of these companies would have raised anyway debt. For the purpose of raising debt, they would have taken a fair value report from a chartered engineer. More often than not, we have seen these reports already being available. You can just consider it and make the tax adjustment and proceed.
Amit, one question from my side also. Just wanted to know that in case if we go by normal DCF value, and then at the same time we do the NAV, wherein the fair value of the land is taken into consideration, and use both of it, will that method not suffice?
For the surplus land, you mean?
No, for the first case, wherein the land is actually being used for the business.
No, the problem is what happens is you are only giving fair value of the land and not valuing the business as such, because that is essentially a breakdown value. It would be, in my view, incorrect, but it is still better in the sense that at least your fair value of the assets is getting reflected in some meaningful manner.
Because otherwise also, as you mentioned, when we are doing DCF, the fair value of the business is anyways considered there, and the fair value of the asset is considered in NAV, and we use a combination of both.
Correct. You can do that, Nikki.
Okay.
So I'm talking more of a scenario where it is a corner case, I would say, where the land value could be much more than the value of your business. And typically in these cases, what we have always done is we have carved out the operations from the business, from the land, by way of a slum sale or a demerger, and then gone ahead with the investment to be done. That way, from a founder or a promoter standpoint, you sort of retain the ownership of the asset, while the investor will not really pay value for the land if he's coming into an operating asset. That way, that is a structural solution, but from a valuation standpoint, these approaches, what you mentioned, is right.
Hello.
Yeah, Harshil.
So actually, I have a question. You just spoke about demerger. So in mergers, when we determine a share swap ratio, we determine a value based upon relative value basis. We mention in the valuation report. To be very honest, I don't know what is relative. I try to find out on Google online. Then I try to connect a lot of values, but I didn't get any concrete answer. What is the difference between what we do a valuation in normal scenario and when we do a valuation on relative basis?
Yeah. So there it will be very similar. Harshil, I don't know if you can reach that slide. Couple of slides I put, I can sort of walk you through quickly. It is essentially the same approach that you will follow even in the relative value. You will apply the same methodology. You will do the valuation of transferor company, transferee company, and one divided by other will give you the swap ratio.
Correct. So, but then why we are specifically mentioned relative value basis when we do a valuation for fair swap ratio, and the valuation we do it for section 62(1)(c) or private placement or fair issue of equity shares.
Relative is when you have more than one only, then it will be relative valuation. If you're doing for only one, it will be standalone valuation. I would think it's a nomenclature difference, not in terms of approach.
Okay, correct.
Okay. Cash and cash equivalent, we need to consider this as surplus asset. typically what happens is there's no distinction or doubt around this thing. If you got FD, I'll have to consider it as the full value. No need to do a separate valuation of it. Problem is, if I got an FD and I want to do a valuation of it, I'll take interest at 6% and I'll discount it at 15% VAT. Effectively, the FD will be valued 40% of the amount. So don't do a valuation of these instruments. Only thing to add here is if you kept any FD for the purpose of getting an LC or something, which you'll never get back, then it is appropriate not to consider it as cash because it will be forming part of your working capital, which is permanently stuck. Similar thing in terms of investments, how you go about doing a valuation. I'll not spend too much time on it. Trade investments is whatever you're done for the purpose of your carrying out your business. These would be trade investments. This can be investment in your subsidiaries, etc. If you have made investment in a subsidiary, it is better to consider DCF of both the businesses together. Or you can also do a DCF on a consolidated financial and a consolidated cash flow standpoint. But better it is always to do sum of parts rather than trying to do a consolidation and then try to eliminate minority interest, etc. if that is the case. If it is non-trade, the treatment is very similar to surplus asset. Do not consider interest or dividend that you're going to get. Just consider the fair value of the instrument as at the beginning of the period. That's about it. It's fairly simple. Bank deposit, we already discussed. It is equal to cash.
Do we need to adjust the minority interest when we do a valuation at the holdco level?
We have to know. So if there is minority interest in holding company will come when you do not own 100% of a subsidiary. Correct. Two ways to look at it. One, if I'm doing sum of parts valuation and say it's a subsidiary which I own 60%, I'll just do the DCF of subsidiary. I'll multiply that with 60% and I'll take 60% value into the parent. Then there is no minority interest because I've just taken what I own. On the flip side, if I've done the valuation on consolidated cash flows without eliminating minority interest, then I'll have to provide for minority interest. That becomes technically difficult because how will you figure out minority interest when I'm not done a valuation of my subsidiary separately? That was the reason why I was saying it's better to do sum of parts, especially when you've got non-100% subsidiaries. But if you've got 100% subsidiaries, pretty much both the things will end up giving you a similar outcome. Harshil, hope I've addressed that query. Okay. Next is tax holiday, etc. If you got now, not many companies are anyway entitled to. So if there is any tax holiday, you will simply consider the benefit of the tax holiday in the while computing the cash outflows technically. The other problem will be more towards what will you do with tax holiday in computing the cost of debt, because you need to do that 1 minus T. Now the T, whether you will take 15% if you have got a 50% tax holiday, or will you consider it at the full rate? That's an assessment you will have to make. Logically speaking, tax holiday during explicit period better to consider. Beyond explicit period, which is into perpetuity, ideally we should not take the lower amount of rate assume that it's going to last in perpetuity. What I've generally seen is if there is in perpetuity period also, if there is some tax holiday, you can always estimate the value of tax saving and add it as a separate line item, or you can just go with full rate and get done with it. And again, if there is a MAT outflow, you will have to consider the cash outflow towards MAT that you're going to have. And again, the critical thing that always keeps coming up is what do you do with the MAT credit in the books if you got. Now, as all of us would be aware, companies can opt for this new or a concessional tax regime under 115BAA. If you were to go down 115BAA, then effectively you will consider a lower tax rate of 22% plus surcharges. Once I consider a lower tax rate, then effectively what happens is your MAT credit would get nullified. If you are not going down this path, Like I've got certain clients which were SEC developers, etc. There the MAT credit is quite significant, so they will continue to be under the old regime for quite some time. In all those cases, you can compute the MAT credit specifically in each of the year, whatever that's going to come. And towards end of the period, if there's any MAT credit, you need to consider the present value of it based on some metrics or some utilization expectation. So again, tax holiday not too relevant. MAT also is losing its relevance increasingly with all companies coming under this 115BAA regime. In this holding company we discussed when I was sort of addressing Harshal's point. I'll probably skip through this. Then again, always a challenge comes up when you're valuing new company because there'll be no projection except for a business plan, whatever. This is where I think people would get stressed out the maximum. And also you have this angel tax issue and all the related notices that one could get. Again, it is quite challenging to do a valuation of a new company. You need to be sort of a little cautious while taking the assumptions, etc. Is there a way to sort of test it or benchmark it? You can't do anything about it. So that's a problem or inherent with the challenge that you got. And only other point is if it's a new company and if you're allotting shares, which is part of subscribed capital in the MOU, at least a valuation for that to that extent is not required. But for that, everything else you need to do a valuation.
Hi, this is Harshil here. So in a scenario where holding company is getting merged into subsidiary company,
yeah,
okay, these are unlisted companies. So in a scenario where economic interest of the shareholders at holding company would remain same as prior to merger. So in that case, the share swap is still required because economic interest would remain same.
So if it is subsidiary merging into parent, Harshil, anyway, there's no allotment that you're going to do.
Correct.
So it's a cancellation of shares. Anyway, there's no valuation that will arise.
Correct.
On the other hand, if you're doing a reverse merger where holding merges into its 100% subsidiary for stamp duty or whatever reason, there again, technically you don't need a valuation report because the economic interest remains the same. What we do is we work something on a target capital approach and close. Saying 1:1, something more like that you can do. Same approach even if you're doing a mirror demerger, wherein you're demerging into a new company. There also the approach is the same. You don't need to do a valuation. You can just say 1:1 is appropriate and move. Even listed companies have done this. Maybe I'll pause here. We run out of time. Yeah, sorry.
So, but do we still require to maintain 1:1? Can we say that economic interest would remain, hence no valuation is required? Can we?
You can do that, but what we generally write is we say that the board has recommended 1:1, and we are fine with it. So in the report, you'll have to write something, no? Which will go from your report into the share swap, into the share exchange ratio in the scheme.
Is there any this kind of report available in public domain?
It is available. We can share one of them from BSC.
It's available, Harshal. You can see a lot of listed companies. Demerger case, you will find the same what Amit was referring. If there is a mirror demerger, so there are a lot of companies report is available, like in the case of demerger, and issued by Big Four and all those also. You will be easily.
Actually, I just wanted this name because I know Adani Gas. I saw that. Except Adani Gas, I didn't find it in public domain. So I will just.
I will. Okay, we'll post this. We'll try to figure it out and send it to you. We'll have few of them.
Thanks.
I'll pause here. There are a lot more slides. I don't think it's appropriate to continue beyond 10.
Shilpa. Yeah, Abraham sir. Yes, this is Subbarao. Yes, Subbarao. Yes. Now I'm going to take vote of thanks. First of all, thanks to Kusum for bringing excellent speakers, both Atul and Amit, and where like day to day we will see all these DCF calculations, and we'll be having lot of doubts, and company to company, the calculations or the perpetuity or terminal value or the assets are very much different. And okay, we have to meet the expectations of the investors as well as the compliance we have to see, as well as the company. And it is a great session, Kusum. And again, coming to Amit and Atul, okay, you covered the session with the pricing and the valuation, difference between pricing and valuation, and what are the consideration we need to take in the case of, and what are the consideration we need to take in the case of net asset value method and marketable comparison method. And we have gone to very deep into that, okay, like how we can value and okay to comply the valuation. Very much useful for all our associates, all our members in Bangalore Value Association. Thank you for wonderful session, and where okay we across okay like multiple scenarios. In case-to-case basis, we have to handle. Okay, these sessions like useful for the members to participate, to actively take into consideration of all complaints. Thank you very much once again, Atul and Amit, and we look forward great sessions from your end in future.
I must thank you, Amit and Atul, for excellent session. It was very informative, and I must thank you, Abraham, the scheduler of this particular session. Thank you. Thank you. It really helped us.
Yeah. I request any other members, okay, to contribute vote of thanks or anything to say about Amit and Atul.
I think you captured it correctly, Subbarao. That is, all these things are doubts which keep on coming up in the mind when we do valuations. And I think that both Amit and Atul have given us some very valuable data points to use in doing valuations. And thank you so much for that.
Thank you. Thank you.
Thank you all.
Thank you,
Atul, I will connect to you separately for the PPTs.
Yeah, sure. I think we will end the session today, Shilpan. We don't have that. We have a group.
Yeah. No.
Today, okay, because of festival, okay, because people are rushing, and okay, today we don't have any what to call communication. Okay, we'll have in this next session. Thank you very much.
Can we have their numbers actually, the speaker's number, Atul and Amit?
Yeah, it is in the slide. Last slide we have put it, and we'll circulate the slide and also.
You'll circulate the slide. Okay, that should be good. Okay. Right.
We'll also be sharing a model for it.
We'll be in touch with you guys. Yeah. Wonderful.
Yeah.
Thank you.
Yeah. And also a great festival. Okay, all Navratri. Very best wishes to everyone. All the best.
Thank you, sir.
Thank you.
Thank you all.
Thank you.
Good luck to all. Bye.